Zimbabwe cash crisis worse.
Talking about Venezuela once again.
Systemic important banks. They removed the one factor called monetary awareness.
Beginning, it seemed like maybe the president is playing some super dimensional chess, and now it just seems like he's kind of smashing the house. I'm hoping that, like some of the things the president has tweeted out, maybe they'll just decline to do the worst part of these tariffs, because if this starts to escalate, it will pull us all into a recession.
Hey there, hope all is well. Back here today with some more RT News updates. And as you can tell from today's title, we're going to do somewhat of a little recession update as two more indicators from the mainstream sources flashes red. And so I have about 6 or so articles I want to share with you, all dealing with some recent commentary from a variety of mainstream sources on the idea that recession is looming, if not already. And so before we dive into these articles, as always, if you're new to RTD, I want to encourage you to click the subscribe button along with that notification tab to be informed of future updates as well as live streams. Also join me on Twitter, where I share posts throughout the day on various subject matters. Make sure you click the button down below to be notified when things are posted. So as I mentioned, I have about 6 articles I want to share with you, but it's very interesting how there's more and more indicators or red flashes that are coming about from mainstream sources, especially financial investors as well as financial institutions, all geared towards giving a warning sign as to what is coming, or in most cases, some people say is already here. And so I want to share with you a couple articles here, and as always, read down below for yourself to find out more for yourself. Just want to skim the surface, give you something to think about on top. So the very first one here is from Market Watch, and it says, this reliable indicator of a bear market in stocks and a recession just flashed a warning. And so if you scroll down here, it gives you an idea as to where this is heading. It has to do with the current employment numbers and the fact that we're at all-time lows, but yet as of recently, there's been a spike upwards, which a gentleman here who's done some research has looked into the past and noticed that whenever there's a all-time low, shortly thereafter, some type of bear market begins in the financial sector, which ultimately leads to a recession. So I want to share with you here some things here. It says, last Friday, the Labor Department put out a very solid monthly jobs report, and the media treated it accordingly. It says employment increased by 213,000 in June, and hourly earnings rose by 2.7% on an annual basis. But it says most pundits underplayed what may turn out in retrospect to be the most significant data. That is, the unemployment rate rose last month to 4% from 3.8% in May. It says, but in a column I wrote last year, I went back to 1948 when the Labor Department first started tracking unemployment and showed that historically, when the unemployment rate hits a low for the cycle, a bear market and recession haven't been far behind. As you scroll down below, it gives you some numbers here. And it says, as a table from the column shows, the low unemployment rate of each business and market cycle over the past 70 years preceded a recession by 9.2 months and a bear market by 14.8 months on average. Still, 9 years into a bull market and economic recovery, we're much closer to the end than the beginning. And an unemployment rate hitting bottom may signal that as clearly as ringing of a bell. So here we have the idea that once we reach all-time lows in employment for that business cycle, as soon as it begins to spike, it's not much longer afterwards that there's some type of market correction, aka a recession. So more information there if you're interested in reading for yourself. Next article here is from Forbes, and it says, with personal debt levels high, potential U.S. recession could spell disaster for homeowners. And so here the article basically mentions that because this economic expansion has been fueled by debt, it basically talks about how it says booming economies lead to economic slumps. So basically what it's hinting at is the fact that a lot of people right now are feeling the economic growth factor as far as their net worth and their housing value going up. But it says, what does a potential recession mean for the average American? And it talks about in most cases, because everyone is heavily leveraged in debt, it gives some interesting statistics here as far as American household debt being at approximately $133,000 and credit cards being at $15,000 on average per household. He's basically saying that, simply put, we owe a lot. And when things we need to live get more expensive and unemployment rises, as so often happens during periods of economic recession, it'll get a lot harder for many Americans to pay back what they owe. It's an issue that could affect a good portion of the population should a recession hit. So the idea that because people are so leveraged up in debt, now this next recession is going to make it even tighter for people to actually keep their head above water. So more information there if you're interested, feel free to read for yourself. Next one here is from Bloomberg. It says a U.S. recession indicator flashes red for Leuthold's Paulsen. So to give you an idea what's going on here, it says one gauge of a recession risk with a pretty good track record over the last half century has just raised a cautionary signal, according to Leuthold Group. It says for the first time just prior to 2007-2009 recession, premiums on the lowest rated tranche of investment grade U.S. corporate bonds have risen to 2% after being below that level, according to data compiled by the Minneapolis-based research. It says analysis looks at the gap in yields between corporate debt rated BAA by Moody's Investors Service and those on 10-year treasuries. Here we have a graph indicating the credit spread over the last 30 years here. And so right around this time frame here, back to 1987, when it went above 2%, we had that stock market crash there. And then it goes to 2000 when it went well above 2% and we had a correction there. Then here we have the subprime situation here where it went well beyond 2% and we had a great recession. Here we are now, July of 2018, and it recently reached 2% as of last week. So something worth keeping note of according to this research group here. So more information there if you're interested in reading for yourself.
It's the next recession.
Recession will be.
Will be a recession.
We're going to hit a recession.
The date of the next recession.
A U.S.-only recession typically lasts 8 to 10 months, but a lot of things about this particular one have not been typical. So
A crash is coming now, whether it's 6 months from now, 12 months, 36 months, no one knows.
I go to bed every night, I dream of another recession. If you know what to do, if you have the right plan to set up, you can make a lot of money from this.
Next article here says the Fed is thinking about throwing out a key recession indicator, and this is from the Business Insider written by Wolf Richter, and it's a pretty good written commentary on the idea that the Fed recently decided to do away with one of the old traditional ways of telling if we're in a recession or not, and it has to do with the inversion of the yield curve here. So if you scroll through here, it gives you some idea what's going on, it gives you some good graphs, all dealing with the U.S. yield curve situation that every mainstream economist is talking about right now. And so here, according to how recessions typically has been gauged over this yield curve situation, we had the one in 2000, 2007, and we're approaching that inverted yield curve here. But as of last month, during a FOMC meeting, 2 employees of the Federal Reserve came out with what they consider a more reliable method of telling them when their next recession will occur. And of course, it was in favor of the Federal Reserve pushing it down the line. And so it says there was no consensus among FOMC members about the lack of reliability of the yield curve as a predictor. But there was a staff presentation about a new recession indicator to replace the yield curve. It says this new indicator, rather than looking at the spread between the longer term yields of 2-year and 10 years, is looking at the spread between short term yields. Says the staff presentation took place during the meeting in June. On June 28th, the Federal Reserve Board published a note that explained in greater detail why this new recession indicator will be superior to the yield curve. And so the question you should ask yourself is why, if there was no concern of a recession, would the Federal Reserve need to come out with some type of new recessionary indicator? And so clearly they are aware some things is happening, and they are trying to divert our attention from the typical mainstream spiel of an inverted yield curve, which has been the primary indicator up until this point, by coming out with their own revised version. And we know that whenever the FOMC and the Federal Reserve revise things, they always skew it in their favor, which cover things up and push things down the road. So more idea of a recession looming, or if not present already. So more information below if you're interested in reading for yourself. Next one here is from Bloomberg, and it says JPMorgan maps out currencies to buy if recession is coming. So here we have one of the 2 big to fail banks mentioning that if the recession is coming, and in my opinion, whenever you hear the word if, lets you know that it's looming, if not already present. But to give you an idea what's going on here, it basically says if a U.S. or global recession is looming, it's time to own Swiss francs, Singapore dollar, US dollar, and Japanese yen, and ditching emerging market currencies, according to analysts from JPMorgan Chase. So if you scroll down below, it gives you a little graph here, but it says, for the record, the team said that talk of recession at this point is premature. They put that in quotations, which also shines light on the idea that it's already present, it's already mainstream conversation, but yet they're saying it's premature. It says, though, concluded it's sensible to review contingency plans amid the likelihood of a further escalation in trade tension. So hinting at the idea that this trade stuff could really be a catalyst into an official recession. It It says emerging market currencies are a clear standout as particularly susceptible to slowdowns, depreciating on average by 17% over a 2-year period, straddling the start of a recession, JPMorgan said. So basically all emerging market currencies, what's happening with South Africa, Turkey, Venezuela, Argentina, all those emerging markets, Brazil especially, he's saying here that on average, after recession, it depreciates about 17% or so. So if you are a viewer listening to me from one of those countries, you should definitely take note of the idea of getting out of your own currency, according to my opinion, and what we hear from this commentary here. But more importantly, what's worth noting in this article here, it says JPMorgan maps out currencies. But for those who have followed Rethinking the Dollar before, you understand that JPMorgan Chase is holding the largest stockpile of silver in their vaults at the tune of 135 million ounces worth of silver. And so if they're telling people to bet on these fiat currencies, they didn't mention anything about the importance of holding silver, which they are the largest financial institution, to my knowledge, in this country especially, that's holding the most silver, which is a monetary metal, i.e. the people's money. So clearly they are well prepared for the idea when fiat currencies altogether go under. So more information below if you're interested in reading that. And the very last article here is a video worth taking a note of, and it started off with a gentleman at the very introduction of this video, but it says, if trade wars escalate, it will pull us all into a recession. And so here we have 6 articles all talking about the same type of things: a recession, economic slowdown, market correction, things of that nature. And it's always interesting, as I said before, there's more and more commentators coming out saying recession, market slowdown. And so here we have 2 new indicators that are flashing red signals to give you an idea of where this is heading. And so that's just 2 of all the other ones on top of that that let you know that there's a market slowdown in the making, along with all the other things that will impact the financial markets, which will ultimately equal a slowdown. And then we have the trade situation going on with China as well as the other nations that we are involved in. And so at the end of the day, when all this stuff collides, it will equal something a lot worse than the last Great Recession. And so it's worth your while to take note of all these external sources, giving you a heads up as to how you should be positioning yourself, in my opinion, outside of all this digital and fiat currency stuff that we've been flooded with. So other than that, it's always worth your while to not necessarily watch what they say, but keep an eye on what they do. And if you know, all the countries around us, predominantly those in the Eastern Hemisphere, China, Russia, are accumulating massive amounts of gold. Then we have JPMorgan here that's telling people to bet on these currencies here, but yet they're the largest silver holder in their country. Then you definitely know where you should probably be looking towards. So once again, this is all my opinion, but yet all this commentary here lets you know where we're heading. Now it's up to you to figure out what you're going to do. So as always, leave a comment down below. I would love to hear your thoughts on these indicators, as well as what other indicators you might be aware of that I may not have mentioned. I would love to shine a little light on those as well. Other than that, enjoy your day.